Now I would like to introduce the next speaker of the day, Mr. Ravi Chauhan. Ravi Chauhan is currently working as the senior manager in MMJS and is a qualified chartered accountant having 8 years of experience. Ravi is currently a part of the IFRS implementation team and has worked on some of the gap analysis and well as FI engagements. Ravi has won a tag of IFRS champion and in an IFRS knowledge quiz organized by ICAI Dubai Chapter. Ladies and gentlemen, now please put your hands for Mr. Ravi Chauhan.
So good afternoon everyone. It's already afternoon from the very good morning of our weekend. So I think it's always an immense pleasure to be a part of the ICAI Abu Dhabi chapter. It's not the first time where I have been invited, in earlier as well, and this is no different this time. It's always a pleasure and to be part of such forum and sharing the stage with such learned speakers out there. Okay, so. Considering the topics which were being covered by the other speakers earlier, so I had designed my agenda accordingly. So probably I'll just directly jump to the agenda, where what we'll be discussing today is the latest updates on IFRS as to what's really happening around the financial reporting world. And also the very important topic which I want to touch base upon is the connection between the IFRS and the corporate tax, which is being implemented from June 2023 onwards in UAE. So starting with the first one, which is the latest updates on IFRS. So here what I've tried to do is to cover the key amendments. Some of them are effective with effect from Jan 2022 onwards, some of them are with effect from Jan 2023 onwards. Which I think Mr. Acharya has already covered a bit, in a summarized manner. So here I'll just quickly list out as to starting with the IFRS 16, which is COVID related rent concessions. Again, IFRS 16 is something which was covered fairly in detail by Mr. Yusuf Hassan, which was planned to be implemented from April 2021 onwards. Then we have the annual improvements to IFRSs of 2018 to 20 cycle. Then we have the amendments to IFRS 3, IAS 16, IAS 37, we have IAS 1 along with the practice statement 2. So these are some of the amendments which are planned to be effective from Jan 2022 onwards, whereas some of them are planned to be effective from Jan 2023 onwards, such as we have amendments to IAS 1 classification of liabilities as current or non-current. We have IAS 1 along with practice statement 2. We have IAS 8, IAS 12, and then we have the IFRS 17. Now IFRS 17 is not an amendment, which I think has been fairly covered in detail by Dr. Aggarwal a few minutes back. So starting with the very first one, which is the rent concessions, which basically came into picture during the COVID-19 pandemic to cater to the economic situation surrounding that. So here, assuming that a particular contract is already a lease contract within the meaning of IFRS 16, let's try to understand that what are really some of the key conditions to apply this particular amendment. So starting with the first one, we have, did the rent concession occur as a direct consequence of the COVID-19 pandemic? So if the answer to this question is yes, we move on to the another question, the another condition, which says that does the change in the lease payments result in revised consideration for the lease that is substantially same as or less than the lease immediately preceding the change? If the answer to this question is also yes, we move on to the other question, which says that does the reduction in the lease payments affect only the payments originally due on or before 30th June 2021. Now here there is an amendment where this particular date has been extended by one more year. So the revised date stands as 30th June 2022. Again, if the answer to this particular condition we say as yes, okay, we move on to another question which says, is there no substantive change to other terms and conditions of the lease? If the answer to this condition is yes, yes, practical expedient may be applied. Why do I say may be applied? Because this is something which is optional in nature and lessee can elect whether to apply it or not. Now, consider a scenario where lessee elects to apply. So, what is the treatment basically out of this particular practical expedient? That the very objective of having these rent concessions in place was to avoid the lease modification accounting, which is a fairly complex if I just compare the whole IFRS 16 guidelines. So, the treatment would be in most of the cases that such change in lease payments, they would be accounted for as variable lease payments in the P&L as and when they are incurred. Now, let us consider a scenario where the required conditions are not met, or in a case where they are met but the lessee is not electing to apply the practical expedient. Then in that case, of course, the normal lease modification or by default what IFRS 16 requires, that is something which needs to be followed. And in case the lease modification is not a new lease, then the adjustment to the lease liability shall be determined using a revised discount rate. Okay. Moving on to the key considerations. So here what I would like to discuss is regarding these amendments, which are keeping in mind the COVID-19 situation. So some of the key considerations could be the exercise of judgment. Now judgment is something which is without which IFRSs are incomplete. IFRSs are principles based, they are subjective, and yes, exercise of judgment is required to assess the original terms of the contract vis-a-vis the revised ones. Then you have the volatile income statement. Now, although the practical expedient is actually intended to provide relief to the lessees, but it may also increase the volatility in the income statement, which may reduce the comparability of your profits after tax, before tax, EBITDA, and the other related KPIs. Another one could be the additional disclosures. Now, this is again one of the key considerations, because see, naturally, if a particular lessee elects to go for this particular practical expedient, the additional disclosures will be required so that the users of the financial statements get the true and fair view of the financial statements, right? By having, by basically reading these detailed disclosures, and these have been fairly listed in detail by this particular amendment. Okay. Now this one is very important, the reconfiguration of the existing systems and processes. So what happens is the lessees would have already implemented a particular system for IFRS 16, right, to cater to the requirements of this new leasing standard. Now when this amendment came into picture, they will naturally have to reconfigure this existing system. So just to save on the time, cost and energy, they will they might not want to go with the practical expedient in spite of meeting all the conditions therein. So this is again one of the important consideration. Another one is the comparability being hampered. Now, why do I say that? Because practical expedient, as I mentioned, it's optional. So because it is optional, the comparability is something which is expected to be hampered, because the financial statements of all these lessees will not be the same or consistent across. Some of them might have opted for this particular practical expedient, while some might not. Although this have been tried to compensate it by way of additional disclosures therein, but then still not every user will have that will have that eye to have a look at it. Next we have the transition, basically the applicability. So here the lessees can elect to apply this practical expedient either for the financial statements for the subsequent reporting periods, or for the financial statements which are yet to be authorized for issue. Okay. Moving on to the annual improvement cycle of 2018 to 2020. So some of the key amendments which I would like to just discuss out here is number one, relating to IFRS 1, which is first time adoption of IFRSs, where the first time adopter is a subsidiary or an associate or a joint venture. So basically this amendment, it permits a subsidiary, associate or joint venture to measure the cumulative translation differences, okay, using the amounts reported in the parent's consolidated FS. It is based on the parent's date of transition to IFRSs, provided that no adjustments are made to the consolidation procedures and to the effects of business combination under which these subsidiaries, associates or joint ventures have been acquired. Another one is fairly simple. It is with respect to the illustrative example relating to IFRS 16. So the example number is 13, where they have just removed the illustration of payments from this particular from this particular example number 13. And the very reason of having this amendment in picture was just to remove the potential confusion which was there regarding the treatment of lease incentives while the lessees applied IFRS 16. Okay, I think this is something which was covered by Mr. Acharya while he gave his presentation. So I'll just quickly touch upon this. So here there is no as such a significant amendment when it comes to IFRS 3 conceptual framework. But what really the primary objective of having this particular amendment was just to replace a reference of 1989 conceptual framework to 2018 framework. So this is just to avoid a potential confusion which was there earlier, and now this is something which has been removed. Just to add on the contingent asset side, now this is something which is important to be noted here, is that there is a new paragraph which has been added, and it clarifies as to that the contingent assets, they do not qualify. So I repeat, they do not qualify for the recognition at the acquisition date. So this is something which this particular amendment to IFRS 3 talks about. And we move on to the amendment to IAS 16, which is with respect to proceeds before the intended use. Now, this is something which is effective from Jan 2022 onwards. So this amendment actually talks about the costs, the sale proceeds of a particular part of the asset which has been sold at the time of bringing a particular PP&E at its present location and condition. So this particular amount from the sale proceeds, now it has to be recognized in P&L rather than netting it off from the cost of the PP&E. So this is the amendment to IAS 16 which talks about. Then we have the amendment to IAS 37 which talks about the contract, the costs of fulfilling a particular contract, especially in case of onerous contracts. Now, onerous contracts are something which are loss-making contracts from day one itself, right? So these particular amendments, they specify that while assessing the onerousness of a particular contract, what all costs are to be considered in that particular assessment. Now that can have two categories of costs. One could be with respect to those which are incremental in nature. Let's say, for example, direct material, direct labor, etc., which you can easily identify. Another one could be the allocation of the overheads, or the examples here which we can take is probably of depreciation of a particular asset which is being used to fulfill that particular contract, or there could be cost of supervision, management fees, etc. Now what is important to be noted here is that the general and administrative costs by default, they are not something which are directly related to a contract, and hence they are to be excluded from this particular assessment of determining onerousness of a particular contract. But then if they are explicitly chargeable to the counterparty under the contract, then in that case we will have to consider these general and administrative costs as directly related to a particular contract and will have to be included in the assessment of the onerousness of that particular contract. So now what is the impact of this amendment to IAS 37? Of course it provides a much more required clarity. It is expected to ensure the consistent application of IAS 37, and of course IFRSs are incomplete without the use of judgment. So judgment is required still in spite of this particular amendment, that which costs would be directly relating to this particular contract and which ones would not. Okay, moving on to the amendments to IAS 1, which talks about the classification of liabilities as current or non-current. Now this is something which is effective from Jan 2023 onwards. So here these amendments specify the requirements of classifying the liabilities as current or non-current by clarifying the three most important points. Number one, it clarifies what is really meant by a right to defer a particular settlement. Then that such a right must exist at the end of the reporting period. And third being that the classification is not affected. The classification is not affected by the likelihood that an entity will exercise its particular right to defer of that particular settlement. Now, what is the impact? The impact is that the entities will now have to carefully read their existing loan agreements and vis-a-vis these amendments, whether they would like to renegotiate anything with their banks. Then we have the amendments to IS 1 read with IFRS practice statement 2. This talks about the disclosure of accounting policies, again effective from Jan 2023 onwards. Now, this is something which is really very important. These amendments require the entities to now disclose the material accounting policy disclosures. Now, this is something which I am putting emphasis on rather than the significant. Now, why is that the case? Because significant, the term significant is something which is not defined under the IFRS framework, but the term material is something which has been widely accepted. It has been very well defined, first of all, under the IFRS framework, and it is something which is widely accepted by the users of the financial statements as well. So that is one reason. And another, it adds guidance on how the entities apply the concept of materiality in making those disclosures. Now, the next question which would come is, how do we assess this materiality, right? So what are the factors which the entities need to consider while determining this materiality? Because this is something which is again very subjective in nature, right? The term materiality, although it is defined, but while assessing that materiality, it involves a lot of subjectivity. So I have tried to put in some of the the factors just for the ready reference, which includes has the accounting policy changed during the accounting period? Was the policy developed in accordance with IS 8 as the in the absence of an IFRS? Sorry, was it chosen from the attachments from the alternatives available in IFRS? I'm sorry. Does it relate to an area where the entity is required to make significant judgments or assumptions? Does it relate to complex accounting that users of the financial statements might not otherwise understand? So these are just, again, these are not the conclusive ones, but some of the factors which could be considered while assessing the materiality. Now, what happens sometimes is there might be some accounting policy information which could be very much standardized and might not be relevant to a particular aspect of the transaction applicable to that particular entity. But it is important to understand the other material accounting policy information in the financial statements. Now, in that case, such standardized accounting policy information could probably be considered as material and it should be disclosed accordingly. So, impact, definitely the judgment will be judgment is required to determine whether this particular policy information is material or not, and careful consideration should be provided while determining whether that standardized accounting policy information is material or not. Okay, we move on to the amendments to IS 8, which talks about the definition of accounting estimates, again effective from Jan 2023 onwards. So these particular amendments to IS 8, they introduce first of all a new definition of accounting estimates. Second, they provide much more needed guidance with regards to the distinction between accounting estimates, accounting policies, and the correction of errors. And lastly, they also provide the clarity as to how the entities will use the measurement basis, the measurement techniques and the inputs to develop these accounting estimates. Now, let us have a look at the amended definitions. So, if we see the definition of accounting policies, these are the specific principles, measurement basis. Now, measurement basis is something which has been added by this particular amendment. Conventions is something, if you see, I have striked out because this is something which the amendment removes it from the definition of accounting policies. So the revised definition is it read something like this, that accounting policies are the specific principles, measurement basis, rules and practices applied by an entity in preparing and presenting the financial statements. The new definition of accounting estimates is something which I believe is very much logical now as far as the nomenclature goes, because the accounting estimates are nothing but the monetary amounts in the financial statements that are subject to measurement uncertainty. Naturally, because since we are not able to measure them accurately, that's the reason we are terming it as accounting estimates. So the impact of this particular amendment is not much, because it just provides the required guidance in terms of the distinction between accounting estimates, policies, and the correction of prior period errors. But definitely it provides the much more required guidance which was not existing earlier. Okay, we talk about the amendments to IAS 12, which is deferred tax related to assets and liabilities arising in a single transaction. Now, again, considering the region which we are into, probably, I'll just quickly summarize this amendment. So, earlier, whenever there is a taxable and deductible temporary differences, the deferred tax asset and liability on these particular transactions were used to be recorded as like they were allowed to be offset, but that is something which is not allowed now and they have to be presented at gross level. Okay, so again, as I mentioned, see IFRS 17, I think it was a fairly long session a few minutes back. What I would like to add to that is that I personally feel that this is something which is not an accounting change. Technically, it is something which is termed as that this is an accounting change. Like we have IAS 17 to IFRS 16, right? We have IAS 18 to IFRS 15. But this, from IFRS 4 to 17, it's not an accounting change. In my view, this is a revolutionary standard. So why do I say that it is revolutionary? Because it's not only changing the financial reporting, elements of it, but the way the businesses or the way the other departments will be involved in the implementation of this. So those who are already implementing it, I believe some of my friends here are already implementing IFRS 17 directly, indirectly, maybe on the industry side or from the consulting side of it. So they already know about the challenges which this revolutionary standard has to offer, and those who are not, you are fortunate enough. Okay, jokes apart. So see, just to add here now, what is important here, okay, just to recap. So IFRS 17, if we talk about the scope inclusions, okay, so it specifically, we need to focus on these words. It doesn't say that it applies to the insurance companies or reinsurance companies. Rather, it says that it applies to the insurance contracts and reinsurance contracts. So what does that mean? Let's consider an example, I mean, in a rarest of the scenarios, that a manufacturing entity decides to issue a kind of insurance contract. Now, assuming that this particular insurance contract, which is written by a manufacturing entity, is something which fits into the definition of IFRS 17, then for that particular insurance contract which is issued by that manufacturing entity, IFRS 17 will have to be applied. I mean, in practice, generally speaking, it is something which is majorly applied by the insurance companies. But just to give you an example, that what is important here to understand is the wordings of the standard. So what they have scoped in is the insurance and reinsurance contracts and not the insurance and reinsurance companies per se. Again, just to touch upon the overall objective of IFRS 17. So IFRS 4, as Mr. Aggarwal already mentioned, that there were comparability issues because of the varied practices across the measurement approaches, or the disclosures were not sufficient. So basically, the very purpose of the IFRS framework, which is comparability across the world for all the companies, was something which was defeated in a way, and that's the reason IFRS 17 is here. We have the consistent presentation, consistent disclosures, consistent measurement approaches. So that is something which will make comparability, it will make comparison more at ease as compared to IFRS 4. And last but not the least, IFRS 17 is a standard which not only involve the finance department, but the actuarial, IT, as well as the other support departments. I am sure you will not believe me, but even HR department will have to be involved in the implementation of IFRS 17. So that is the level of involvement which is required while implementing this standard. And just to add, I mean, on the practical side of it, so there are a lot of insurance companies, at least in the GCC region, who are basically they have decided to basically prepare the parallel set of financial statements for IFRS 4 and 17, at least for the 2 to 3 years post the implementation of IFRS 17. So you can just imagine the level of difficulty which the board and senior management also will have to grasp these concepts, the new concepts under IFRS 17, and the way the KPIs will work, the profitability is changing, and the impact on equity, etc. Now just to add here, see, while I speak about the IFRS 17, it is not changing the overall profitability, right? Because it's not changing the business per se, right? So business will stay, it is just a financial reporting standard. So the timing of the recognition of profits or the revenues, that is something which is undergoing change over the coverage period. The profitability itself is not undergoing a change. And just to add one last point on this, which is in connection with IFRS 9. So all of those entities who are implementing IFRS 17, they have an option to defer the implementation of IFRS 9. And again, majority of the companies are going ahead with this option to defer, because it makes easier for them, and because there is a kind of overlap as well between IFRS 9 and 17. Okay, I think it's back. Yes. Okay, great. So I think the last topic which I would like to touch upon today is the connection between the IFRS and corporate tax. I think a lot of people are asking nowadays, especially after the regulatory authorities have released some kind of guidelines in terms of corporate tax, that this is something which is effective from June 2023 onwards. So what role really IFRS have to play in that? So if we see the wordings of these regulatory of these laws, okay, the draft laws which are out, it says that the businesses, the applicable businesses in the UAE will have to maintain the books of accounts as per the internationally acceptable accounting standards. So they don't really say directly that it is IFRSs. But now, why do I say IFRSs is because IFRSs are the world's most widely applied accounting standards. More than 130 countries now, they either require or permit the use of IFRSs. So naturally, all the applicable businesses, from the corporate tax perspective, if they are not already maintaining the books of accounts as per these internationally acceptable accounting standards, they will have to start maintaining the same. Now, why do I say that is because to arrive at the tax profits under the UAE corporate tax regime, the very starting point for you is your accounting profit or the so-called book profits. And that has to be as per the internationally acceptable accounting standards, which in most of the cases we can say it would be IFRSs. So that is something which I would like to leave a thought of on the connection between the IFRS and the corporate tax. So that's it from my end. Thank you very much for listening patiently, and happy to take the questions.
So a big round of applause to CA Ravi Chauhan for his excellent presentation on the IFRS update. May I request Mohammad Shafiq, our secretary Rohit Dayma, and our past committee member CA Anand Gupta to come to the stage to hand over a memento to CA Ravi Chauhan.